Kia ora, welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. Before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Today we're joined by Jonathan Oram, who is the Chief Financial Officer at The Warehouse. Welcome, Jonathan.
Kia ora, Dan, and kia ora, listeners.
It's great to have you on. Do you want to start with a little rundown on what The Warehouse is for anyone who hasn't heard of it and how it's been performing lately?
Sure. Okay. So, The Warehouse has five brands within its portfolio. The Warehouse that everyone knows well, Warehouse Stationery, Torpedo 7, Noel Leeming, and The Market, which is an online marketplace. The business is actually celebrating its 40th anniversary this November, so a major milestone, and we've been listed on the NZX for 28 years. We've had a long history as a listed retailer in the New Zealand market. We only announced our result 3 weeks ago. It feels like it was a lot longer ago than that, but the way we pitched our result was a strong result in another year of disruption while we've continued to invest in the business, because 2022 was unfortunately once again highly disruptive because of COVID, with what everyone knows well, the 84 days in Auckland and 74 days of red in post-Christmas. And so with group sales of $3.3 billion for the year, which is our second highest sales number ever compared to FY21, we were happy with that result. That was 3.5% down, but within that there were some good signs of the business performing. So Q2 was our strongest Q2 for the total sales ever, and we could see over the course of a year, if you look at the quarterly sales numbers, which we break out by brand and do release every quarter, you could see the Warehouse coming through as customers are seeking out value. Some other numbers that that people would have seen, and I think Dan you'll focus on a little bit. Online was up significantly, nearly 40%, 15.3% of sales, and that really was driven by that first half lockdown, and it did come back in the second half, but it showed our ability to actually deal with that sort of volume, and it's set the business up well going forward as we continue to grow that channel as part of integrated retail. Gross profit margin, this has been a real area of focus for the group, and that was down 110 basis points to 35.3% for the full year. We were okay with that result, given most of that once again occurred in the first half, and that's when we in particular saw the impact of shipping costs and also some unusual COVID-related costs come through, which impacted our gross profit margin. In terms of comparable NPAT, we finished the year with $96.9 million, and that compares to $175 million last year. So FY21 was an exceptional year, but if you compare it back to FY19, a pre-COVID year, that was an NPAT of $74.1 million, so significantly up on that. And actually, if we look at our history, it's our second best result since 2007, which was 15 years ago and early on in the group's growth journey. The last thing I would say is Capex. It's a big year for Capex. We spent $140 million, and I'll use this term pre-SaaS adjustment, because we have made an adjustment to our Capex numbers in our accounts for cloud-based computing costs, and that compares to $84 million in FY21, and an average in preceding years was more around that 65 mark. So there's been a massive step up in investment.
Yeah.
And finally, dividends, 20 cents of dividend, compares to a pre-COVID dividend of 16 cents for I think for the 4 years up to FY18, and then we paid 17 cents in FY19. So that's a big, that's a good trajectory. FY21 we did pay 37.5 cents of dividend, but that included a special dividend
Special
because
dividend.
we paid no dividend in FY20. So a 20-cent dividend is it's a pretty attractive gross yield when you look at our share price.
Yeah, and of course, as investors here, we love dividends. That's what we live for.
Yep.
Arguably, as well as some capital gains is nice as well. So yeah, let me jump into that pandemic result, because as you said, the pandemic. It's a difficult time to trade. You had some days where you're not trading, and yet you've managed to deliver a pretty strong result, paying one of the biggest dividends you have. How do you think about the pandemic being a net positive, a net negative? Was it so bad for the business in the end?
So look, it was bad in that when you look at some of our brands could cope very well through the pandemic. So going back to FY20, when we were actually in complete lockdown for a period, and then we got to level 4, brands like Noel Leeming could do, with all the stores shut and just doing online, could do up to 60% of their volume. So their average basket size for Noel Leeming is just over 1 unit, and so and online fulfillment is executed from store. So it has a very efficient model for delivering online. So it proved to us actually, that business is very resilient, and there's opportunity on how we push online and physical in-store purchasing. With the warehouse, when you're dealing with an average basket, which is over 5 units, and a lower dollar value per unit as well, it's a lot more difficult to fulfill online orders, and online sort of begins to cap out when you're getting up into the 20-30% of sales. So it's definitely an impairment to the business when you can't open up physical stores, and we saw it was very clear during 2020, but then in 22 when we had stores open in the rest of the country, but we were still locked down in Auckland, you could see that quite clearly in the store performance. So we were pushing out as much as we could through our network, but through the stores into the New Zealand Post. But there's just actually literally physical constraints on how much you can process. Look, I think a big plus though from all that has been just, like I said before, stress testing our existing processes and systems, and that's giving us some guidance on when we may need to invest, how we may think about click and collect in each of the brands, and so that it's definitely had some positives.
Yeah, that's interesting, because obviously when you can't sell things, people can't come into your store, you do worse. But if when you open your doors, more people come into the store and they buy more than they would have during the period, did you find that usually it tended to balance out somewhat?
It balanced out in, look, after the lockdown in FY20, we saw a resurgence of demand, and the numbers were quite phenomenal in those first few weeks coming out of lockdown. And then we saw an elevated level of demand for a prolonged period, literally probably 6% up week on week on the prior year. And that flowed through to 21. And so I think the problem is you had a bit of catch up, but then you had the result of the stimulus that the government put into the economy. And this is now the global phenomenon that we're all dealing with, because that has caused some imbalances in the economies around the world. So look, I think we definitely would say, caught up in 22. Look, there was a bit of a catch up in Q2, but certainly I think we're confident that there was a real loss number in terms of sales that just wouldn't repeat, that occurred because of the lockdown.
Yeah, I think you're right in that the pandemic roller coaster is not quite finished yet, because we still have the virus and we still have the inflation, which is the effect of both low interest rates and government spending. The kind of things are yet to normalize, even if they are beginning to normalize. Would you agree with that characterization?
Well, yeah, but the inflation is something that is obviously it's a very big issue, live issue. 7.2% release yesterday. That was a surprise. What does this mean for? First of all, what is it meaning for our customers and cost of living pressures. I'll come on to how we think we're positioned, but secondly, what it means for interest rates and the OCR. That's a real concern, because that's just going to potentially turn up the pressure even further. And now they're saying 75 basis points is the likely rise in November, and you'd have to agree with that. You've got the Fed in the US saying that commentators are saying the next increase there could be 100 basis points. So we're in this very difficult situation globally. We've got central banks increasing rates in parallel with each other. And then you've got this phenomenon in New Zealand where a lot of our imports are US dollar denominated. And, we've got to deal with that. And we've obviously got hedging in place, which helps us manage through that. But there's at levels where to sustain themselves at the level they are now will go lower, 55, 56 cents and lower. That would be an issue for the economy in general, rather than just just us. So from a value perspective, I think it does play into what's core to our offering, especially in the warehouse, where we do look to offer customers value, and that's a combination of price and quality of product. And we have definitely we were seeing it towards the end of FY22. I think it will play out further over the course of this year, where the value proposition that we can deliver to customers will come through. And all retailers are going to be faced with the same exchange rate issues. And I suggest maybe the larger ones will have been taking out hedging, and the smaller ones possibly could be more exposed. More specialty retailers and smaller chains to the level of hedging they've got in place. So, we think we're in that context, we're well positioned.
Mm-hmm. So you buy goods offshore. You mostly pay US dollars for those goods. You bring them here, sell them to us in a lot of cases, and obviously that exposes you to the exchange rate. If our dollar goes down, it costs you more to buy those goods. You have to charge more for them here. Can you talk about how you hedge and what hedging means in this context? What is your hedging policy, if you like?
Yeah, so our hedging policy is between 0 and 4 months of payments. We've got future payments. We hedge 80 to 100%, and within 5 to 12 months we hedge 50 to 90%. At year end, we had a blended hedge over the next 12 months of 69% at a rate of 67.5 cents New Zealand dollar US dollar exchange rate. So we do that by taking out forward exchange contracts. We don't do anything exotic beyond that, and I think that will be something that some companies, some businesses will want to try and not lose the potential for the upside if the exchange rate does swing back the other way. We just stick to our policies, and we'll use forwards. And part of the reason that we're pretty disciplined about that is what's really important internally for our team is to have visibility on what is going to be the delivered exchange rate to them. So what are they going to be? What are they going to have to pay suppliers at? And that then helps them make pricing decisions and ranging decisions, and even specification decisions around product, because we need to balance what we're offering to customers. And this conversation's in particular in relation to the warehouse limited, which is 1.8 billion of our 3.3. That is a very important factor about how we maintain value in a basket of product. So consistent for us, removing that volatility is a key component of that, as well as hopefully within the bands, there's a little bit of room to also make some decisions around how heavy we want to go within those bands.
But you're mostly still hedging your currency risk, even with the currency at this very low level.
Yep, we will keep it within those bands that I described.
Yep.
Now for Noel Leeming's interesting, because that's a big business within the group, over $1 billion, but they're buying off distributors who are based in New Zealand. And so there's some direct source product, but the bulk of what we sell is New Zealand dollar denominated, sourced from distributors locally. So it's up to the distributors how they're managing their hedging. And the thing about consumer electronics as well is, and maybe Moore's law is not a great example at the moment, given what's been happening to silicon to chips. But the price of a 40-inch TV has only been going one way for the last 20 years, and so it's quite hard to actually break down where pricing is coming from in terms of exchange rate impact. But that's a better, that's quite a nice position to be in from a consumer electronics perspective in terms of having those larger multinationals manage that pricing and exchange rate risk.
You raise an interesting point there. We kind of have lived through a period of, a sort of low inflation, or in technology, even a deflationary environment for years and years. Some people are sort of saying that perhaps that's starting to turn around, and we're going to live in an environment where things generally start to cost a little bit more. More things are produced onshore. Supply chains are more resilient, but more expensive. Do you think we're sort of heading into an environment where those sort of deflationary forces that have made TVs cheaper every year, do you think that could start to go away? And we could start to see an environment where lots of things are a little bit more expensive because we need that supply chain resilience, or we need to onshore, or technology, silicon parts are hard to come by?
I would say probably not for the range of products we largely sell, and the way New Zealand's set up. There's a lot of it was 40 years ago, which we don't have now. Hard to see them coming back. I think there in some cases, so there's a global issue, in the case of semiconductors, around reliance on some particular markets like Taiwan for production of, I think it's about 2/3 of semiconductors globally. So things like that could have could have consequences if we don't develop more resilience around key components that may be concentrated in some, in that particular case, a country which is right in the middle of some current political positioning. Food-wise, you'd have to think once again. Hopefully, we're well positioned New Zealand is well positioned to actually deal with diversification of food sources. There's certainly, elsewhere in the world, there would be countries where they're highly dependent on imports for food, and that's become an issue. But look, I think largely for our portfolio, consumer electronics potentially around some of those component issues. Otherwise, we direct source 70% of our product, all the home and apparel product that we sell in the warehouse, lots of that, sourced in China, India, and Bangladesh. And we continue to make sure we have diversity in that, because, and even within China, you can have quite significant diversity within regions. So, it's not just importing something from China, it's importing from different parts of China that can give us some resilience, because they've had, and they continue to have, actually some localized lockdowns.
Jonathan, let's talk about your portfolio of products, because the conventional wisdom is when you're experiencing inflation or a recession, people tend to cut back on spending what we call consumer discretionary, or sort of luxury, or nice to have, and they sort of are willing to dedicate more of their income to consumer staples, sort of the must-have, warm clothes, food, those sort of things. The warehouse kind of does both. It sort of has affordable things, and as well as some essentials, but you have a range of other sort of types of stores, Noel Leeming, the warehouse stationery. How do you think your portfolio is positioned in either an inflationary or a recessionary environment? Do you think something can navigate through well, or will it be something that eats into your sales, revenue, and profits?
Yeah, I'd say this is really where the benefit of having a portfolio of brands comes to play, because the warehouse has traditionally, the warehouse as in terms of red sheds, has performed very well in difficult times, and we saw evidence of that coming into year end, and I think we'll continue to see a flight to value in that business from customers. So that should perform well. We do expect that, that Noel Leeming and Torpedo 7, it will be more difficult, and potentially based more around trading events, as people are just a lot more sensitive to getting value from those particular brands. I think we're well positioned when it comes to Noel Leeming in terms of our market position, so we should be able to offer the best the best value in those events versus the market. And when it comes to Torpedo 7, I think an interesting dynamic will be, depending on how tough things get, just New Zealanders still, everyone still needs to have leisure and recreation time, and doing that in New Zealand, I don't think is going to change, the bias towards doing that, even though the borders are open. I don't think we're going to see the same. I think it's going to take longer. We all know it's going to take longer, really, for airlines to ever return to anywhere close to what we had before. So the theme of holidaying at home is going to continue. So there could be a bit of a pause. Maybe everyone's binged out on things like mountain bikes, and we need a bit of a catch up there. But I think bike sales globally, that's another global phenomenon we've all experienced. Just an insane amount of consumption of new bikes there, and e-bikes. But that's created also the sport has grown a lot. So warehouse stationery, a little. I'd expect it to be somewhere in between, and that's the theme of studying and working from home. That's gone through a phase where people are geared up for it, but I think we're all comfortable that there's going to be that hybrid way of working and learning is now here to stay. So we've got a market to satisfy there.
Mm-hmm. Interesting. So probably the big red sheds are probably the most recession resilient one with the most value, and then on the other side you have Torpedo 7, lots of discretionary items, although it may still do okay. Noel Leeming, big purchases, people might try to avoid them for a few years, but there's still good value there. So that's kind of like then warehouse stationery, somewhere in between. That's kind of the range you've got.
I think there's also a tale of, something that we haven't seen for a while in New Zealand is the amount of building consents that have gone through over the last few years, new product that's coming onto market. Now there may be, I think there's an expectation we will see that slow down, but there's a lot of housing apartments that are in flight, and if you listen to every single newly elected mayor talk on Sunday morning, they were all talking about what they're doing in their particular regions to make new housing more easier to execute. So I don't think there's still legs in that part of, which is a major catalyst for people making a decision to buy product if the developer's not buying the product directly themselves.
Mm-hmm. Right. Every new house needs a fridge and a TV.
Yeah.
Okay. So another thing that is sort of very interesting, very topical right now is the shifting grocery sector. The government's become quite unhappy with the duopoly, thinks prices are too high, very keen to bring in competitors, and have been doing a whole bunch of regulatory action to make that happen. One company that's a little bit interested in joining that space is The Warehouse. Talk to me a little bit about your interest in sort of expanding your grocery range. What do you offer now? What would you like to offer? Where is that at?
Yes, well, I think it's probably worth taking a step back in time to 2006 when we did launch into grocery, and we launched pretty hard. I mean, back then the business was growing very quickly, and we had a lot of expectations from the market as well to keep that growth up. And what may have started as a more modest intention in terms of a launching of an offering, more like an Audi, became a hypermarket. And we launched with these massive extra stores, 10,000 square meters plus. They had chilled, frozen, they had alcohol, they had pharmacy. And I think we went a bit far there. In terms of the scale of what we were trying to execute, without actually shoring up the one element that probably where we came unstuck was and what's incredibly important to the grocery game is availability and having supply for customers to shop. So we, ultimately, when we look at grocery now, there's an element of grocery which was what we want our customers to add grocery to their basket, and we want to provide value. In particular, we think there's a value proposition which is very core to our core values within the warehouse. And our intent at the moment is to do it as we are doing, which is in an incremental fashion. We've got the near-term objective would be able to provide an ambient, a full ambient, grocery shop to customers at value. And we're getting closer to that. So we're not talking about throwing in chilled and frozen product, but at some point that may be something we could step into. But it's a lot more incremental approach rather than suddenly see a step change. And part of that is just about the supply chain and access to product. So if you think about supply chain, we get up to provide product into the warehouse with a turn, stock turns of somewhere between 4 to 6 times. Supermarkets operate, up towards 20 plus. So it's a much higher frequency of delivery and replenishment in stores, and that's one element. And then the supply bit is just establishing supply sources for product. That's something that we're coming from a very low base. We have had a range in our stores over the years, sort of left over from when we pulled back in 2000, late 2000s. But that needs to be rebuilt.
Yeah. Now the government has asked the duopoly to open up their wholesalers to provide supply to people. I understand Warehouse is sort of engaging with them, or how is that process going? Can you get supplies from the duopoly's wholesale sides of the business?
Yeah, look, I can't comment on exactly where those discussions are at, but we are considering all options. So that's something that we'll pursue. It makes a lot of sense for us to be able to purchase off a wholesaler rather than actually trying to establish elements of a supply chain that we would need, or getting to scale and relationships is also something that takes time. So if we're going to make a difference, and that's what the government is wanting other parties and the likes of us to try and do, then that's a key component. If we can reach an arrangement with existing wholesalers.
It's interesting. You talk about the entry to grocery in the 2000s, and you sort of presented the failure there as being going too far, too fast, and it didn't quite work. An alternative explanation is that Foodstuffs and another supermarket owner actually bought a very significant portion of the warehouse during that time. And many people say that rather than the strategy failing, they say those new owners tried to block it. Is there any truth to that? Did the sort of the duopoly supermarket owners attempt to block the warehouse's entry into grocery in the 2000s?
Well, they only took 10% each in terms of Woolies and Foodstuffs, and with that stake, they didn't have representation on the board or any influence in the business. So that's not true, that statement. It did cause the share price to appreciate a lot, and I think that made I wasn't there at the time, but I suspect that became a focus of the team as well, because the business was seen as highly strategic from an acquisition perspective. But look, no, there was nothing direct in terms of that in that state.
Okay. And the decision now to pursue grocery doesn't relate to the fact that those companies sold their stake just within the past 2 years.
It's incredibly coincidental, really. It's you'd argue, why on earth did they hang on to that stake for so long? Woolies sold many years before that, and that was basically a new CEO came in, had a look at it, and thought, why on earth do I have the stake still? So just moved it on. we've been thinking about for some time. What else can we do within our footprint? And I think that's an important consideration. We've got an 89 store network in terms of the warehouse stores, and they're big stores, and it's about getting the most out of those big boxes. So that's why we saw within the store program with warehouse stationery. That's been incredibly successful in terms of putting stationery stores that are more retail focused, rather than there are some that are bigger and maybe have more of a business focus, but putting those ones inside a red store, and blue stores not only benefiting, the warehouse stationery stores not only benefiting from high foot traffic, but also we have an immediate reduction in our rental costs, lease costs. So that's delivered probably $6 to $7 million in rental savings to date, that program.
Yeah. We better go to listener questions soon, because that's what we're really here for. But before we do, just a couple of quick ones. We've obviously been experiencing a lot of inflation, part of it due to the weak dollar, part of it due to supply chains. Are you seeing any sort of disinflationary effects as shipping costs come down? Are you starting to see the prices of some of the goods you buy actually fall? Are there any deflationary effects you're seeing?
So shipping costs, that's another interesting one. It's similar to FX, in that we contract for shipping costs, out for at the moment we're out 12 months on those costs, and we did get exposure to the significant ramp up in costs. One, and when we reset our shipping contract, but two, we do have a small exposure within that to the spot rate. For us to be out of money, we would need rates to drop by more than 30% from where they were at their peak. So we're pretty comfortable with the contracted rate we have at the moment. And so I look in the foreseeable, like in the near term, next 12 months, 15 months, I wouldn't expect that to be, because we'll have inventory that we'll have to sell through. You're not going to see the benefit of low shipping costs actually come through. But after that period, so possibly 18 months out, we will hopefully be able to start to see the unwind of those costs. And those costs, as I'm sure you well know because you're asking the question, have been significant in terms of their appreciation. They went from sort of 2% of COGS up to about 8% of cost of goods sold. So that was the first sign of inflation that we saw that we had to deal with. So yeah, look, I'd love to say we could pass those back through sooner, but we've contracted there. So if it did drop significantly, we would look to see what we could do to recontract at lower rates.
Yeah. Okay. So to clarify, you are seeing those costs come down, but you've fixed onto a contract, and so those cost savings won't appear in New Zealand on the shelves until sort of 12, 18 months.
Yeah, that's right.
Okay. Super interesting. Thank you for sharing. Let's jump into listener questions. And the first one is from David Johnston, and he asks, has the introduction of Costco put pressure on supermarket chains or New Zealand's homegrown and successful warehouse chain? I would like to suggest the monopoly can be fixed at the farm by supermarkets not having sole exclusive contracts with its producers in the country. So they're asking, has the introduction of Costco put any pressure on the supermarket chain or changes the way you're thinking about grocery at all?
Yeah, I think the introduction of Costco is actually pretty exciting, right? So it's always good to have competition in the market. It makes us all a bit sharper. Look, a couple of points. One, Costco has one store in Auckland. You have to pay membership to be able to go to a Costco store. It's free to go to the warehouse. Ultimately, sure, they may build a network of 4 or 5 stores, but it's not a significant impact at the moment, or any impact at the moment. We're actually seeing a halo from their presence in West Auckland, up at Westgate. That's actually making that shopping centre there. So perversely, it's actually a good thing at the moment. And look, I think but the impact on grocery, that could be quite interesting, because you've got a party who knows how to buy at scale, coming in sourcing product. So that, that's one of the biggest issues we have. And what the government and Commerce Commission have been looking at is that there's no one else who's trying to source products. So that's part of the second question, which is, that's for various reasons over a long period of time, and these duopolies just didn't appear overnight. Those relationships are very strong with the existing wholesale and retail operations and grocery.
Gotcha. Okay. Another question from Anthony Stone, something we've covered a little bit. Will the warehouse be venturing further into the supermarket business, and could it eventually become a key player?
Yeah, so I think we're pretty clear about this. Our aspiration is not to become a countdown or pack and save. I think you'll see. We want to be able to, to deliver a shop. In the near term, it's more of an ambient shop at value, a full ambient shop to our customers. But we don't. To do that, we don't need. If grocery over time was 20-30% of the store, that would be significant, right? But we're not going to see us dedicate a store to grocery or open up, a grocery dedicated store. So it's a much. We will keep on chipping away at this, but you're not going to see us suddenly try and launch a third chain.
Okay, yeah. And will your goal there to be profiting from food sales, or will it be about getting more people through the door buying other merchandise like it originally was pitched back in the 2000s?
Look, it's both, right? And typically what you see is you see the basket increase as we get existing customers, and particularly we've got one of the things that we've launched over the last 18 months is Market Club. Market Club, from a standing start in October last year to year end, acquired 600,000 customers, and we're doing our promotional activity within the warehouse behind Market Club. So, delivering existing customers value in grocery is incredibly important, and we're definitely seeing a larger basket size from those customers who are taking advantage of those promotions around food. And then secondly, over time, you would hope you start to drive traffic, and that's through building scale and credibility, because it is a change in mindset. I think we've begun to see a lot of it before we even came along. You were beginning to see customers, maybe consumers, shop at more than one place for their grocery needs. Mixed shop across various chains. But I think that's where we would have a role to play. If someone's buying product from the warehouse, GM product, they can also they add grocery to that basket.
Yeah. Okay. Here's another question about the economy. With inflation still persisting on the global economy, interest rates on the rise, and New Zealand GDP showing weak growth year to date, is this negatively affecting sales? And if so, do you forecast a rebound in consumer spending in the next 12 to 24 month period?
Yeah, look, as I said, so far we're just seeing a continuation of what we were seeing at year end. We give quarterly sales updates. We've got one coming through on the 11th of November is when we give our Q1 sales update. And really importantly is that in terms of our result, Q2 is very significant in that. And so we typically don't give guidance if we are going to give any guidance until after that Q2 period. Well, I think the point is that Q2 period is going to be a real indicator on where we're going, in terms of the economy, whether we do see how we see that perform. Typically, that's if the first quarter was 20% of group sales, the second quarter's 30%, and then the following two quarters are 25 each. So that's a big step up when you think about total sales. So I think that's going to be a real test. Look, we just don't know. But as I've said, the warehouse itself as a value proposition, historically, through other periods of recession, we've seen it perform very well. So that gives us some confidence about how the group's going to perform with that in its portfolio.
Okay. And probably the last question we have time for, but somebody asks, how does the market work? The online purchases appear to come from companies other than those in the warehouse group, e.g. Hobbyland. Can you break down what the market is and how does it work?
Yeah, so the market is a marketplace, it's a platform. So we have 4.5 million SKUs from third-party merchants that we have onboarded to that platform, and we have then got a customer base that at the moment you're seeing the market as a separate website, and it's acquired a customer base that buy off that platform. So they're buying, we do also sell warehouse products through the marketplace platform, but we're mainly selling third party. So we don't own the inventory. We're not taking inventory risk, but there is a commission that we are charging on the way through. So it's very similar to, in a way, to Trade Me. Trade Me is obviously primarily used goods, but it does also do some first party new goods, with new third party product. So, but the market is as any user, and hopefully many of the listeners have tried it out, is quite a curated marketplace. It's not a we will sell anything and everything, and you can onboard yourself Amazon. There is some control over what we're showing through that channel. We see that as a really important part of group strategy, though, because we want more customers to start with the warehouse group before they, in their shopping journey, rather than going somewhere else. So if, I think over time you'll see the market, as you have with other retailers offshore, an example would be Walmart, and they bought jet.com. You'll see some of that third-party product actually turn up on the warehouse app, the warehouse website. So it will enhance the existing range that we've got. Let's say we've got 80,000 SKUs, within the Warehouse Limited. You're adding, a significant multiple on that in terms of the tail of things that people can buy. We think that's going to be really important to acquiring new customers and retaining them within our group. So it's got a big part to play.
Okay, brilliant. Hey, Jonathan, that's probably all we have time for. Thank you so much for joining us today. Really appreciate having you on.
No, thanks. My pleasure, Daniel.
And thanks everyone else for tuning in. We really love having you watching. Next week, we're going to be back here, same place, same time, joined by Brad Olson, the principal economist at Infometrics, although you may know him as that guy from TV. He's going to help us unpack inflation, high interest rates, and what it means for investors and the average Kiwi. I think for some of us, the inflation number this week was a little bit of a shock. So we're going to go through that and work out what it all means. A link to register for that discussion is in the chat right now. Please enjoy the rest of your week and stay safe.